when it comes out of the sentiment, the price of gold goes up. So yes, the track record now, it's a little over 60%. When we reach extremes, either bullish or bearish, we know with a 60% probability that not only will the sentiment reverse, but more importantly, 60% of the time or a little more, the price of gold will go in the opposite direction. So if you get an extreme bearish indicator, the price will go up 60% of the time. And if you get an extreme bullish reading, the price will go down 60% of the time.
Steve Hanke, a well-known professor of economics, has come up with something called the Hanke-Cofnas Gold Sentiment Score. It's a special tool that helps predict what might happen to the price of gold. This tool looks at lots of news stories about gold and uses clever computer methods to figure out if people are feeling bullish or bearish about gold. The Hanke-Cofnas Gold Sentiment Score uses a web scraper to measure the sentiment of news stories about gold. This is the first time market sentiment has been used and measured in the specific price discovery process. Steve Hanke, along with his partner Abe Cofnas, worked hard to create this tool. They made a smart computer program that goes around the internet, finding articles about gold. The price of gold is currently lower than an important level at around $1,955. This level used to act as support, but now it has turned into a barrier that is hard for gold to break above. This level is calculated using a special math tool called Fibonacci, and it also lines up with another indicator called the Bollinger Band. Let's watch snippets from Steve Hanke's interview, but before getting into the video, make sure to subscribe our channel and give this video a thumbs up. Currently, 96% of our viewers have not subscribed to our channel. We are so excited to have reached 1,000 subscribers. We couldn't have done it without your support. Our next goal is to reach 2,000 subscribers. Please consider subscribing to our channel and helping us reach our target.
What does this sentiment measure? Number one, it's the only sentiment measure that I'm aware of that quantifies what sentiment actually is using high frequency data every hour. So it's neutral on the hour. We're talking about an hour sentiment. It might, the next hour, it might be bullish or it might be bearish. We don't know. Or it might be neutral. It might be stuck there for a while. So we're measuring sentiment every hour, and we do this with what's called text mining. We look at the articles that come out every hour, and obviously with a computer, we're not reading every one of these things. We have keywords that are contained in those articles, and the computer finds those words. And some of those words are bearish and some are bullish. And when the computer gets done with its text mining, we can determine whether that article is bullish or bearish on gold. And that's how you get the sentiment score. And then what if the sentiment score is an extreme? Let's say it goes very bearish. You mentioned the word bearish. Let's say it goes very bearish on us, and the scores go from -10 to +10. Let's say it swings over to -10, very bearish. What does that tell me to do? That tells me that the price of gold will increase. Once the extreme bearishness is in the market, it will revert, and the bearishness will come out of the market when the sentiment. And now the key is we have algorithms we're developing to trade off the sentiment. So one thing that's interesting is we're measuring sentiment for the first time on a high frequency basis. But the interesting thing is, how do you connect that to trade? And that's where we connect the trading algorithms. And so far, we're making money. If you know the reversals occur 60% of the time, you know if you get a trading algorithm, you should be able to figure out how to make money with that. And so far they are. They're turning, depending on the algorithm, the returns are about 30 to 50% per annum. You have to be smart enough to to program the computer, and you have to be smart enough to get the dictionary of what is a bearish word and a bullish word. So it's just not a mechanical thing where you set a computer wild on something and the computer does everything. You have to know what you're doing, and you have to give it directions. Once you give it directions, it does a lot of work for you because it reads the article. Hanke doesn't have to read the article.
In this interview, Hank highlighted that Fed is monetizing the debt. Debt monetization is when a government gets money from its central bank to pay for things it needs, like public projects or services, instead of borrowing from regular people or raising taxes. Hank highlights that the government borrowed money to pay for its spending, and the Federal Reserve created money to pay for those borrowings. This increased the amount of money in circulation, which led to higher prices. Between 1953 and 1974, the central bank made more money, and the government's borrowing rate was around 5%. But banks didn't earn any interest on money they kept with the central bank. This big difference in rates gave banks a reason to lend money instead of holding onto it. When banks lend, it creates more money, which can cause prices to rise. This interest rate gap likely played a big role in the high inflation of the 1970s, known as the Great Inflation. When the central bank made more money and the rate difference was large, it encouraged banks to lend more. This added to higher prices in the economy. Hank is expecting things to slow down in the near future, possibly even a recession, in the early part of 2024. He believes that Powell made a mistake by creating too much money, and now he's not handling the situation properly to fix it. Let's watch Steve Hank's interview with David Lynn.
You see, people say, well, how did if they didn't increase taxes to finance all this big increase in government spending and they created a deficit, well, how did they finance a deficit? It had to be financed some way, and they didn't do it by increasing taxes. What they did, they issued government debt, and instead of issuing that debt to the non-bank private sector, the Fed bought over 90% of it. The central bank did. So that's what we call monetizing the debt. So the Fed credits the government for the treasuries that they buy from the government. And when they do that, that increases the money supply. And that's why the money supply went up and hit a peak in 2021. It was growing about 26% year over year. The highest rate of growth in the money supply on an annual basis we've had since World War II. And now it's contracting minus 3.6%. So we've gone from this huge explosion in the money supply with a lag. We then got inflation, and now we've had this contraction going on really since early last year, and we have seen prices come down. Inflation is down at 3% now and going lower, and with a lag of 6 to 18 months after big changes in the money supply, we see real economic activity change. And that's why I can say with confidence that we will have a big slowdown. I can use the R word, a recession, early in 2024, the first half of 2024. It's baked in the cake in the sense that the money supply has already gone way down. And with a lag of 6 to 18 months, you get changes in real economic activity. And those changes with that lag will come in the first part of next year. Powell is the one who produced the inflation in the first place. He's trying to put out his own fire. I think he's not done it in the right way. And the right way would be to be paying attention to the money supply growth. And if he'd been doing that, he would have never monetized the debt in the first place. And he would have kept the rate of growth in the money supply around 6%. He would not have let it explode up to 26% on an annual basis. And he would not be in the situation where now they're contracting at 3.6%, minus 3.6%. So he's mismanaged the whole thing.
What do you think about the Hanke-Cofnas Gold Sentiment Score? Do you think it is a useful tool for predicting the price of gold? And what do you think about Steve Hanke's views on the Federal Reserve and the potential for a recession? Let us know in the comments below. That's all from us. If you like this video, please like, share, and subscribe to our channel and click the bell icon to be notified when we release new videos.